Hello everyone, welcome back to my channel Risk Modeling Hub. Ever wondered who really watches over your bank? From London to Delhi, Brussels to Washington, each country has its own financial watchdogs. But why do some rely on one regulator while others have many? And who makes the rules that decide how much capital banks should really hold? Stick around because in this video we will be discussing how banking and risk regulation works in the UK, India, EU and the US in the simplest way possible. So let's get started. PRA, Prudential Regulation Authority. So how banking regulation works in the UK? In the United Kingdom, banks and other financial institutions must follow certain rules to stay safe and sound. These rules are made and monitored by different authorities. Let's break down who does what and what the major parts are. Central Bank, Bank of England. The Bank of England is the UK's central bank. It plays a big role in keeping the financial system stable. It doesn't just print money, it also oversees the overall economy and ensures the financial system doesn't collapse. It acts as the foundation for everything else. Prudential Regulation, PRA. That is, the PRA is a part of the Bank of England. Its main job is to make sure that banks, insurance companies, and large investment firms are financially strong and well managed. It checks whether these firms have enough capital, money to absorb losses, and whether they can survive bad economic times. So, what are the capital rules? That is the Basel framework, the standardized versus the IRB approach. Capital rules in the UK are based on international Basel guidelines, but tailored by the PRA for UK firms. Under the standardized approach, banks use fixed formulas provided by the regulator to calculate how much capital they need. And under the IRB approach, that is the internal ratings based approach, banks use their own internal risk models to estimate risk like default probability and the required capital. However, this approach is more complex and it needs the PRA approval. Now let's talk about the loan loss provisions, that is the IFRS 9, the incurred loss versus the expected credit loss. So, under the accounting standard IFRS 9, banks in the UK must set aside money today for losses they expect in the future, not just losses that have already happened. Earlier, under the old incurred loss model, banks waited until a borrower actually missed the payments. Now, with the expected credit loss, that is the ECL, banks must forecast the likelihood of losses and make provisions in advance. This change helps prevent underestimating risk and makes financial statements more forward-looking. Stress testing, BOE and the PRA. Banks must prepare for tough times like a recession or a market crash. To do this, two kinds of stress tests are used. Stress testing, BOE and PRA. First is macro stress test. It is run by the Bank of England. These check how major banks would handle extreme economic situations like rising unemployment or house price crashes. Next is the internal stress test and the ICAP, which is reviewed by the PRA. Banks run their own internal stress scenarios as part of their ICAP, that is the internal capital adequacy assessment process. The PRA reviews these as part of the SREP, that is the supervisory review and evaluation process, to make sure the bank is managing risk and capital properly. Model risk management, the SS1/23, the PRA guidance. Banks today rely heavily on models to measure credit risk, capital, stress impact, etc. But models can be wrong if not designed or used properly. So, the PRA has published the SS1/23, the Model Risk Management Principles, to guide banks in managing the model risk. The key principles include: first is the governance, who is responsible for models and how decisions are made. Next is validation. It is testing if models work as intended. Next is monitoring, checking if models stay reliable over time. Last is the documentation, that is keeping detailed records of how each model works. This ensures that model doesn't become blind spots and that banks don't take decisions based on the faulty calculations. So putting it all together, what we have discussed till now is, in the UK, the Bank of England provides financial stability. The PRA regulates banks to make sure they are safe. Rules around capitals, provisions, stress tests, and models are all designed to ensure that banks can survive crisis and protect depositors. This layered system helps keep the UK financial sector strong even when facing uncertainty. Now let's discuss the RBI, the Reserve Bank of India. Banking and risk regulation in India. Let's get started. In India, the responsibility for making sure banks operate safely, stay well capitalized, and manage their risk wisely rests mainly with one powerful institution, the Reserve Bank of India, the RBI. Unlike the UK, where regulatory functions are divided between the Bank of England and the Prudential Regulation Authority, the PRA, in India, RBI handles both roles under one roof. Central Bank, Reserve Bank of India. The RBI is India's central bank. It plays a huge role in the economy by issuing currency, controlling inflation through interest rates, managing the country's money supply, acting as a banker to the government and other banks. It also oversees the financial health of banks and ensures they are not taking dangerous risks that could hurt the economy. Prudential regulation. It is also done by the RBI. So, in countries like the UK, prudential regulation is handled by a separate authority. But in India, RBI itself is the prudential regulator. This means RBI sets the rule for how much capital banks must maintain, how much risk they can take, how they should manage credit, market, and operational risk. So, it not only ensures monetary stability but also makes sure banks don't fail due to poor risk management. Capital rules, Basel guidelines, standardized versus IRB approach. India follows the Basel capital standards, which are international rules designed to ensure banks have enough capital buffer to absorb the losses. There are two main approaches to calculate the capital requirements. First is the standardized approach. Most Indian banks follow this. It uses fixed risk weights given by RBI for different type of loans. Internal rating based approach, the IRB approach. Only a few large banks are allowed to use their own risk models. RBI is cautious in allowing this approach and gives approval only after the thorough review. So, the RBI monitors both the approaches to make sure banks don't understate their risk just to hold the less capital. Loan loss provisioning, the IFRS 9, expected loss versus incurred loss under the RBI. In line with the global accounting practices, India has adopted IFRS 9 standards through IND AS 109 for some banks. This means instead of waiting for a borrower to stop paying, that is the incurred loss, banks now estimate expected credit losses, ECL, ahead of time. This allows for early warning and early action. However, full adoption of ECL by all banks is still in progress, especially for public sector banks. Stress testing, ICAP and RBI's financial stability report. So, stress testing is a way to check whether a bank can survive a crisis like a recession or market crash. In India, stress testing is done in two ways. First is the internal stress testing, that is the ICAP. internal capital adequacy assessment process. Each bank must assess its own risk and capital under different stress scenarios. This is reviewed by RBI to ensure the bank has a proper risk plan. Next is the macro stress test, Financial Stability Report FSR. So RBI publishes a semi-annual financial stability report. It runs system-wide stress tests to see how the banking sector would perform in case of severe economic problems. So model risk management. In countries like the UK, model risk, that is the errors in the risk prediction models, is taken very seriously, and the PRA has set clear principles like the SS123. We have discussed this before. But in India, there is no dedicated model risk framework yet. Banks are expected to validate and monitor their models, especially under the IRB approach. But RBI has not released specific guidelines for managing the model risk. This is an area that may evolve in the coming years as Indian banks adopt more advanced analytics. So, in a summary, RBI performs a dual role in India. It combines the role of central bank and the bank regulator. It sets the monetary policy and ensures financial stability. It regulates the banks and monitors the capital adequacy, oversees the risk management and stress testing. No separate regulator needed. RBI handles everything. Now let's talk about the EU, the European Union. Banking regulation in the European Union. The European Union is made up of many countries. So naturally, banking regulation is a shared responsibility between several institutions. But don't worry, it all works together to make sure banks stay safe, stable and well managed. Central Bank, European Central Bank, ECB. The European Central Bank is the main central bank for countries that use the euro, the eurozone. Its main responsibilities are deciding interest rates to keep inflation in check, the monetary policy, making sure the financial system stays stable, and issuing the euro currency. Unlike the Bank of England, which works only for the UK, the ECB works across multiple countries in Europe. It has a much broader reach. Prudential regulation. The Single Supervisory Mechanism (SSM). To keep big banks safe and sound, the EU created the Single Supervisory Mechanism (SSM). This is a system where the ECB directly supervises significant, large and important banks. Smaller banks are mostly supervised by national regulators in each country. They work together as a part of a joint framework. This ensures consistency across countries and avoids weak regulation in any one member state. European Banking Authority (EBA). It sets the rule book. The EBA is not a central bank or supervisor. Instead, it writes common rules for all the EU countries. It ensures harmonized supervision across borders. It supports cooperation between the ECB and national authorities. Think of EBA as the rule setter, while ECB is the enforcer, especially for big banks. Capital requirements. Basel rules via CRD4 and CRR. The EU follows Basel capital rules but implements them through its own legal framework. First is the CRD4, that is the Capital Requirements Directive. It covers qualitative rules like governance, risk management and disclosure. CRR, Capital Requirements Regulation. It contains quantitative rules like formulas to calculate the capital needs. Banks in the EU can use either the standardized approach, that is using fixed weights given by the regulators, or the internal rating based approach, that is using the bank's own models after the approval. Just like in the UK, EU banks follow the IFRS 9. So banks estimate future losses and set aside capital now, that is the expected credit loss or the ECL. The old method waited for a problem to happen first, the incurred loss, but that led to delays during the financial crisis. Now, ECL helps banks act earlier and prepare better for bad loans. Stress testing, EBA and ICAP. EU banks must test how they would survive under pressure. Economic stress. First is the macro stress test. These are led by the EBA and cover all large banks across Europe. They stimulate harsh conditions like recession or market crash and publish the results. Internal stress testing, ICAP. Banks do their own internal capital assessments under different risk scenarios. This is required under CRD 4 Pillar 2. National regulators and the ECB check if banks are properly prepared. Model risk management. EU banks use complex models to estimate risk, but these models aren't always perfect. So there is EBA REP 2023/29. This defines clear expectations on how banks should handle the risk of relying too much on models. EBA Supervisory Handbook. It provides tools and processes for regulators to review and monitor the model risk. This ensures that banks don't make bad decisions based on the flawed models. So in a summary, let's see how it all works in the EU. The ECB acts as a central bank and the main supervisor for large banks. The SSM ensures coordination between the ECB and national regulators. The EBA writes the rule to ensure fairness across countries. CRD 4 and CRR apply Basel rules in the EU framework. IFRS 9 ensures early loss recognition. EBA stress test plus ICAP. It makes sure banks are crisis ready. Model risk guidelines help prevent the over-reliance on faulty models. So if you are finding this content helpful and informative till now, don't forget to subscribe to my channel and hit the bell icon so you never miss an update. The content so far and the upcoming content will help you to crack the credit risk modeling interviews and will give you a holistic overview regarding the regulations and how the banking works. Now let's discuss the United States. Banking regulation in the United States. The US doesn't have a single banking supervisor like the UK's PRA or the EU's ECB plus EBA setup. Instead, multiple regulators share responsibilities depending on the type of bank and the risk involved. Let's break this down by function. Central Bank, Federal Reserve System, the Fed. The Federal Reserve is the central bank of the United States. Its job is to keep the US economy stable and healthy. It does this by controlling interest rates and money supply, managing inflation and employment goals, providing emergency liquidity to banks if needed, overseeing certain banks and financial institutions. Think of Fed as the brain of the financial system, constantly adjusting things to keep everything in balance. Prudential regulation. It is a shared job. In the US, prudential regulation, ensuring banks are safe and sound, is split among three main agencies. Each one supervises different types of banks. First is the OCC, Office of the Comptroller of the Currency. It oversees national banks and federal saving associations. It makes sure these institutions follow the rules and stay financially sound. It ensures banks offer fair access to services and treat the customers properly. Next is the Federal Reserve, the Fed. It supervises state chartered banks that are members of the Federal Reserve System. Overseas bank holding responsibilities and foreign bank branches in the US focuses on both day-to-day operations and long-term financial health. Third is the FDIC, the Federal Deposit Insurance Corporation. It regulates state-chartered banks that are not members of the Federal Reserve System. It insures customer deposits up to $250,000 per depositor per bank. It steps in if a bank fails to protect the depositors and maintains the stability. So, depending on how a bank is set up, it could be supervised by the OCC, the Fed, or the FDIC, or even more than one of them. Capital rules, Basel implementation, the standardized versus IRB. In the US, banks must hold enough capital to protect against unexpected losses. These rules are based on Basel standards but with a US specific twist. The Federal Reserve and OCC oversee how banks calculate their capital needs. Most banks use the standardized approach based on the fixed risk weights. Larger banks can apply the advanced approach similar to IRB, but they must meet strict model and data quality standards. Note, in the 23-24, US regulators proposed changes to align more closely with Basel III reforms, especially for the largest banks. These are still under review. Loan loss provisioning, CECL, current expected credit loss. Instead of waiting for borrowers to default, US banks now follow the CECL model. CECL stands for current expected credit loss. Banks must estimate future credit losses upfront for the lifetime of the loan. This is more forward-looking than the old incurred loss method. The CECL model is similar to IFRS 9 expected credit loss, but has some technical differences in implementation. Stress testing, CCAR and DFAST. US regulators use two main programs to test how well banks can survive a crisis. First is CCAR, the Comprehensive Capital Analysis and Review. It applies to large, systematic, important banks. Require banks to project their capital needs under extreme economic stress. The Fed reviews and may restrict dividends or share buybacks if results are weak. Next is DFAST, the Dodd-Frank Act stress test, a more basic version of stress testing. It focuses on banks with over $100 billion in assets, ensures even mid-sized banks are preparing for downturns. Together, these tests help make sure banks have a solid cushion in bad times. Model risk management, SR 11.7. As banks rely more on models for credit risk, pricing, capital planning, etc., managing model risk is critical. The US follows a key guidance called the SR 11.7, Supervisory Guidance on Model Risk Management. This outlines that banks must validate the models regularly, track model performance, have strong governance over model use and limits, document assumptions, inputs, and controls clearly. SR 11.7 applies especially to larger banks but is considered best practice across the industry. So, in a summary, let's see the US regulatory system at a glance. Fed, the central bank plus key supervisor for large institutions. OCC, it oversees the national banks. FDIC, covers the deposit insurance plus some state banks. Capital rules, it is Basel based with US interpretation. Provisioning, CECL model for forward-looking credit loss. Stress test, CCAR and DFAST for crisis preparation. Model risk, managed using SR 11.7 guidance. Now let's see the Basel rules around the world. The Basel framework is a global standard that tells banks how much capital they should hold to stay strong during tough times. But each country or region implements Basel rules in its own way, based on its regulatory setup. United Kingdom. Here the PRA leads the way. In the UK, the job of applying Basel standards falls to the Prudential Regulation Authority (PRA). The PRA sets capital rules to make sure banks have enough cushion to absorb the losses. It reviews whether banks are using the standardized approach, that is the fixed risk weights, or the internal rating based, the IRB approach, banks' own risk models. The PRA also makes sure banks manage capital conservatively and have strong internal controls. Think of the PRA as the guardian of the capital strength for UK banks. Next, the European Union. The CRD4 plus CRR means the Basel in action. The EU uses two major legal tools to apply the Basel rules. CRD4. It covers the qualitative aspects like governance, disclosure, and risk strategy. CRR, Capital Requirements Regulation. It focuses on quantitative rules like how to calculate the capital ratios. CRD4 is a directive. Each EU country must turn it into local law. CRR is a regulation. It applies directly across all EU countries. No changes allowed. Together they form a harmonized capital rulebook across Europe, all based on Basel III. United States. They split the responsibility and have one goal. In US, multiple regulators handle Basel implementation. The Federal Reserve Fed sets capital rules for large and internationally active banks. The OCC, Office of the Comptroller of the Currency, oversees capital for national banks. US banks mostly follow Basel III, but with some homegrown modifications called the US version of Basel. There is also a push for Basel III endgame reforms, currently under discussion, which would raise capital requirements for the biggest banks. The US keeps Basel flexible, balancing global standards with the national interest. Now let's come to India. Here, RBI is the Basel gatekeeper. In India, the Reserve Bank of India (RBI) handles everything related to Basel capital standards. It provides detailed guidance to banks on capital calculation, risk weights, internal model approvals for IRB. The RBI also regularly updates its Basel implementation to keep up with global changes. Basel III reforms are fully adopted and Basel IV is being phased in. The RBI plays a dual role. It acts like both the regulator, like PRA or OCC, and central bank, like the Fed or ECB. So I have put all the things we have discussed so far in a summary table. The Basel implementation by region. So first region is UK. Here PRA implements the Basel. The key frameworks used by them are the Basel III and the standardized versus the IRB approach. Next region is the USA. Here the Fed and OCC implements the Basel. The key frameworks used are the US version of the Basel III and some evolving rules. Next region is the India. Here the RBI implements the Basel. The key frameworks used are the Basel III adoption and the Basel IV, which is still in progress. So that's all for today's topic. I believe the overall knowledge will help you in the more awareness when you work in the industry and in the banks. So if you found it useful, do like, share and subscribe. And don't forget to leave your thoughts in the comments below. See you in the next one. Thank you.